As the Disruptors panel at the 2025 Africa Financial Summit in Casablanca continued the conversation, some of the highlighted points included a reduced need for cash as transactions become more digitized and the need for security as an important metric to maintaining a healthy working relationship between fintechs and banks on the African continent. Let's have a look.
What I want to say is that from conception, we are supposed to be aligned with banks and MFI because we are supposed to be complementary. We don't have the same regulatory status. We don't have the same customer by principle because we are supposed to serve on the bank. However, it can happen that we share the same customer. I will talk about it. For me, the first benefit is we are acting as cash collection arm for banks. As a fintech, we are acting as a cash collection arm. Because we digitalize cash transaction, we are moving cash from people pocket to people wallet. We are moving the cash that are in people pocket to people wallet. Thus, we are moving the cash from people to our bank account, digitizing that. So we are mobilizing cash for banks, and this partnership allows fintech like us to increase. For bank, the benefit is they increase the volume of deposit in there, and we allow them to capture a lot of, for Wave, I can say that we allow them to capture hundreds of billions of ZOF in countries where we are operating. So this is the major success of a partnership between banks and fintech. And why is this important? Because we are helping them to do their job.
I don't think that we will have cashless societies, but we will have less cash society. And I think we all agree that this is the way to go. And what Cora says that she's moving cash from the pocket to the wallet, and this requires technology, and it's really important. And she ended up by saying that more and more the fintechs are actually distributing services of banks through their own channels because they have most probably a capillarity that the banks do not have, and this is the way it should be, and this is how what is working. But this cannot work without, I think Cora mentioned 3 or 4 times API. Those APIs are, at the end of the day, technology that needs to be consumed, but needs to be consumed with making sure to preserve what matters the most to the bank is the trust. So security is absolutely crucial here, and we need to make sure that those APIs are done in the most secure way, but at the same time not breaking the consumer or the consumer experience, not making sure, like we have seen in some countries, some places, getting a digital experience and pop in the middle. We have to go physically to sign a paper. This is totally not working, so we go back to our first question. But what I'm trying to say here is that those API needs to be absolutely normalized at the level of security, that when a fintech works with a bank and invests in this connectivity, in this technology, that when we need to go to another one, we do not have to rebuild it again and again. So this standardization is really important, and it is through this standardization that we will be able to scale.
For me, I think if we want to have a successful partnerships, we need to start by aligning the vision with the partners. And we need also to have these trust capabilities. And for example, in Cash Plus, we've built the compliance very early before building technology and distribution reach. And that's why right now it's more easy for us to partner with any banks. So right now, for example, we work with banks as we are a payments institution. We need to have a bank who can where we can deposit our cash collection like Wave. So we have an escrow account, and we have operations in real time with this bank, so debit credit real time with them. And we've built this confidence and this trust through years. Now we see that as we have this compliance culture in our DNA, it's more easy for us to discuss with banks, to integrate with them within, how I can say it, a controlled framework. So when we come to a partner, we come with a set of APIs that we already used with other partners. And they are more, they welcome us more easier because we have this experience that we had with many partners. But there is sometimes also, as I said earlier, there is sometimes some issues because they see us as a competitor. And this is, I think, one of the main challenges that fintechs have to work on it. We are here to complete a value chain. Banks cannot do financial inclusion by their own. And fintechs cannot scale without trust. So we are obliged to partners. Banks will bring this trust, fintechs will bring the agility, the scale, etc. And this is, I think, what we every time I'm meeting, I'm discussing with startups and etc. This is what I'm promoting. Please, you have to be trustable with your partners, and you have to have this confidence that if you have this compliance in your DNA, technology and other things will come.
How we made it work, right? I think the important thing for me is everybody in the value chain plays to their strengths. And I'll sort of little elaborate on this, right? We work cohesively with mobile money providers, like the likes of Wave. Some of our partners are here. Their core competency is the ability to acquire customers, to help them, enable them to transact, to make their services and better, to make their lives better, etc. For me to go ahead and source new customers, I think for me, it's nonsensical, right? There is already a pool of customers available who don't have access to a certain service. On the other hand, we work with banks who are our capital providers, and we have close to about 13 or 14 banks who trust our ability to manage the risk for them, right? Collaboratively, we're sort of taking credit decisions along with them. And we sort of realized that rather than sourcing the capital ourselves, the cheapest form of capital that can be available is the deposits, right? So the best way to operate is to partner with banks who already have the entire value chain on sourcing capital already sorted for them, right? And they have their compliances. I mean, they're reporting their hundreds of ratios, which we don't know, right? I mean, with respect to the CARs and the liquidity ratios and the leverage ratios and whatever, right? And so for us, we had to make the thing work with having the strengths of each and every one of us together and accomplishing the same goal. So for example, if one of us has a certain challenge, right? The others need to come on board and service or and be ready to accept that fact that challenge is for the ecosystem and not just for one of them.
We are using technology to improve financial services. So we use technology to offer better financial services with a better user experience. So we use AI-powered models to better know our user, in addition to the proximity we already have on the field.
So AI will bring value across the value chain on the customer relationship and in its very large expression up to the bank for fintechs. Courage says that yes, the customer experience, I think there is this hyper-personalization point that is very important. When we're boarding a customer, will be able to hit exactly the product that he needs while transacting. The transaction will be, in one hand, very much secured with AI, fraud, etc. But at the same time, detect if this customer may need or not a loan, may need or not a help, may need or not a route to transact. So AI will be across the whole value chain, even at the end of the relationship to reduce attrition. So definitely.
At Cash Plus, we process millions of transactions in cash on a daily basis. We think that cash and digital are not true words, but they are true languages, and AI have to be the translator. So our merchants have a lack of visibility, and digital have to make this invisible visible. So for us, we are working to make all these merchants visible, and working with our partners banks to provide, and we want to provide credit scoring systems that lets banks knows more these merchants.
AI is the backbone of our company, right? So the entire business model is based on the uses of AI, right from customer acquisition, where we use propensity models to acquire the right customer, to credit underwriting, offering the right limit to the right customer, and then collections, right? In all of these, we've used massive amount of machine learning, and now as we move on, AI. But one of the most interesting things now we are seeing for the usage of AI is around financial literacy. I think from a risk management perspective, one of the core reasons we've seen that particularly MSMEs and the unorganized businesses, the repayment rates are low is because they don't understand some of at least the credit products we work with them on, right? And so we've taken some bold steps to really make the customers understand what they are opting into, right? And so we've lately worked on some voice bots where the customer can sort of dial in, ask questions, and then there's a bot programmed looking at historic engagements with the customer. So the customer says, my credit limit is down, how can I increase it? Or I haven't paid back in time, can I get a way to structure my repayments? And all that we are trying to use AI, and particularly some of the recent Gen AI models to respond back to them, to educate them on this particular aspect.